So, I'm sure you are almost grounded after 1.5 hours now. But we tried, especially Tom talking about our key markets, oil and gas, chemical and petrochemical, utilities and energy, how they are developing, what they will require going forward. Also trying to tell you how we see our role being in Europe, the market leader in what we are doing, and the opportunities to also adjust our portfolio to even better meet the requirements and the needs of our clients. And then, of course, Duncan talking about how we are very committed, are very prepared to make sure that we deliver the year 2020 and secure profit and growth beyond 2020. So where will this journey then lead us? And our planning period is, of course, beyond 2020. It's 21 to 24, even if we are digging deeper in 2020. And then we have target setting, ambitions and plans for the next coming years. So looking at the financials going forward, our ambition, our plans are built, as I said before, closing the last 2 years with an organic growth of 6%, now expecting a flat top line for 2020. And then from 2021 to 2024, we are committed to deliver a 5% organic growth every year, year on year. That will take us as Bilfinger organically above the 5 billion revenue line. On the EBITDA side, closing at 2.4% in 2019, now guiding and being committed to deliver a big step up to 4% in 2020, and then 5% from 2021. And you see here a commitment that we will be in line with 5% and then above the 5%. Looking at numbers, we will exceed the 250 million EBITDA. You also see down at the bottom end the EBITDA reported. And here you see that we are from Q1 convinced and committed to deliver one EBITDA. So we will have smaller amount, and I come back to that, of adjustments also in 2020, and then phasing out in the first quarter of 2021. So leaving the adjusted and the reported world to one real EBITDA. On the free cash flow reported, we see the 57 that I mentioned for 2019, and taking this year by year up to above 200 million in 2024. This is our commitment, this is what we are working hard on, and this is what is motivating and driving us to really keep our promise, not only for the last 2 years, but also going forward. Looking at the two main drivers, we have spoken a lot about the need to improve our gross margin, that we closed at 9.5% in 2019, and in the next coming 2 years, we are taking up to 12%, and thereafter even above 12%. How do we do that? We do that with a more solid execution, more commercially driven, but a better contract management. From the beginning, setting the scene so that we are making sure that the contracts are set up in such a way that we will generate more and better margins. But also making sure that claim management, which is an essential part of project management, on a continuous basis actively is driving us forward. But also what was mentioned, being what I say a bit picky in good markets with good growth, that we are making sure that we are driving for the right contracts, and that we sometimes also have the strength to say no thank you if some of the contracts are not offering the opportunities to get up to the 12%, even if we do our utmost. Utilization in a people's business is essential. Also working harder on making sure, not only due to our seasonality, but also in general, that we have solid, better, stronger utilization rates. On the SG&A ratio, continue to build on the success that we have delivered, getting this number from 8% last year down to 7.5% this year, and then to 7% or even below in this planning period. And how do we do that? We continue to do it in the same way as we have done so far. We try to be more efficient in the organization, to be leaner. We try to continue to reduce the number of legal entities, because that will take out complexity and improve efficiency, economy of scale in a lot of the SG&A areas. But also making sure that the system harmonization with the same joint IT support will be finalized, and that we utilize that joint platform more and more efficient. This we have done, this we continue to do. Looking at the special items, and I'm picking out the two main items here. I said to you that in 2019 we had 40 million for restructuring and a bit more than 30 million for the IT or system harmonization. Looking now at what is left to come on adjustments. What is left to come on P&L? It's 30 million. We are expecting that we will have a little bit of restructuring, as you always have, in a transformation, but much smaller amounts in 2020. And then we will have the finalization of the rollout of ERP, our SAP platform, also then having an impact on 2020, and a small part, 5 million, in 21. So these are the adjustments we are expecting in the next coming 2 years phasing out. There is, as always, a certain delay in the cash effect. So as I said, we provided and took in the P&L effect of the restructuring in 2019. Most of the cash effect we will only see in 2020 as we implement our plans. So this is our commitment in regard of adjustments, and then from Q2 2020, one single real EBITDA. SG&A efficiency, I mentioned the continuous drive to reduce the number of legal entities, to reduce complexity and lower the overheads. You see here our track record. We had 279 legal entities in 2016. We closed last year with 160, and we are confident with what we are doing right now that we will get below 150 by the end of this year. Right now, we are merging entities in US, we are merging entities in the Netherlands, trying to drive for less complexity. But of course also, if you have larger entities, you will also have more skilled people. You can afford to have more professional people focusing on different tasks. Looking at the system harmonization, we finalized the HR platform, the project that we call Hercules, last year. So the rollout was finalized in December 2019. We are well on the way for also the ERP, the SAP implementation. We have decided, based on our experience in the rollout, to expand the scope. Originally, 66% of our total revenue was foreseen for SAP. We have now expanded that with 28%. So when we have finalized the rollout, we cover 94% of our revenue with the SAP joint platform, which is helping also the integration. It is helping us to work together. We had a number of projects, Hinkley Point, BP, Gelsenkirchen, where companies from different Bilfinger countries are working together. Having the same system platform is making it so much easier and so much more efficient. Looking at the rollout here, we have done 70% by the end of 2019. We are planning to have 90% of it done by the end of this year. So also here, proceeding in accordance with our plan. And last but not least, in regard of the system harmonization, it is extremely important for the transparency, to make sure that you really talk about the same things. You have the same definitions. Talking about this entity and technologies that hurt us so badly in the first half of last year, only when SAP was implemented, we got full transparency of the projects. So not only efficiency and cost saving, it's also about transparency. Looking then at our, what I call bread and butter, our E&M, our engineering and maintenance segment. And these numbers you see in the reporting, we are simply adding up the segment E&M International and E&M Europe. That brings together almost 3.7 billion of our sales. Here we are convinced that we will continue to grow. So from 2021, we will see 5% organic growth in our bread and butter E&M business going forward. Looking at the profitability today, if you add up the results here, you will see that we last year were around 4% EBITDA adjusted in E&M. And this we are obviously then taking up above 5% until 2024. But of course, this journey will go faster, so the 5% will tick in here during the next coming 2 years. I think in E&M, it will not even require that we get to the end of 2021 before we see the stable, sustainable 5%. This is very much what we are good at, and we need to strengthen our strength. Working capital management. A story that never comes to an end. If someone working on this is taking more than 2 weeks of holiday, I see the traces. That's the hard thing. Working capital for us today is a bit different than it used to be, because the old Bilfinger was having a very good working capital thanks to very, very high prepayments from the construction business. That's over. The amount of prepayments in our business is actually year on year, because the clients are more conscious about cash, reduced. But nonetheless, we are trying to use the opportunity for prepayments in projects wherever we can. Accounts receivable, we have very solid clients. When they get the invoice, they normally pay on time. We can't complain that we are losing money on bad payers or on companies that are not surviving. So the main area for further improvement here is the work in progress. That is generating 32 days of the 74. And how can we improve that further going forward? Awareness. Cash has also got a price tag. So all the projects, they do not need just to pass the profitability. They also need to pass the liquidity and the cash planning. Looking at contract and claim management, that should be a fundamentally important part of our business and of project business in general. We have recently started to employ more and more people specialized on contract and claim management to give this more focus. That will help us to reduce the WIP, to set the contract in a different way, but also to drive the claims during the projects and not only at the end of the project. We also look, of course, at any possibility to improve our payments term in the contract area. And of course, the clients do the same, but the awareness that cash is also with a price tag, that's something that we have been driving this culture and we continue to drive. Of course, on the DPO side, we see the 69 days that we, I think, quite healthy, achieved by the end of December. That is a number that we also continuously need to get up. I don't want to say how far we can get it, because that depends also on the amount of large projects that we have. But by making more and more procurement together, increasing the bundling, but also work on the rates here, I'm sure that we will also be able to improve our track record on the DPO side. And as also mentioned, our SDI system has been adjusted this year to not only measure the performance at the end of the year, but to measure it on a quarterly basis. Looking at our financial model, we want to be, and we are, a low-risk business with a recurring business, with a strong focus on Europe and a diversified customer base. We have a number of large customers, but we are not depending on one or two. So this is our profile. We are representing a sustainable revenue growth, back to the 5% organic growth again from 2021, and obviously the last years with even 6% organic growth per year. Starting to look at bolt-on acquisitions, because not only because of having the funds, but also having the stability in the company to successfully be able to integrate any kind of bolt-on acquisitions. We want to achieve industry-leading margins. So the 12% gross margin, the 7% or even below 7% of SG&A ratio. These are industry-leading margins. And a strong cash generation, a very asset-light model. In 2019, we had a net capex of as low as 50 million. So also a strong awareness how we spend the capex, a strict working capital management, a high free cash flow that then can be utilized for dividends or bolt-on acquisitions. This is our financial model. Looking at capital allocation priorities. On one hand side, we have a situation where Bilfinger is rated by S&P at BB with a stable outlook. But we are clearly committed and are working hard over the next coming years to get Bilfinger back to an investment grade. That requires that we are fulfilling the criteria, and I have listed some of them here. And if you look at 2019, we are not yet meeting these criteria. If we are achieving what we have set as our target for 2020, we will be there. But it will take a little bit longer because it has to be a sustainable track record to bring us back to investment grade. But next time when we go for refinancing, we want to have an investment grade to also get a more attractive interest rate when we are going for the next funding. We have a clear dividend policy. During the last years and also for 2019, we are suggesting the floor dividend of €1 to give something to our shareholders in the transformation. But we are committed to then continue from 2020 with a 40 to 60% of adjusted net profit. Making sure that the fact that we will have some cash will not send us out on a shopping tour making things that will not make sense. We have very strict M&A criteria for those targets that we are looking at. EBITDA accretive 1 year after integration. ROCE exceeds WACC 2 years after integration. Asset light with focus on ROCE, as Tom said, an immediate start of integration when acquired. Very strict criteria, not always easy to fulfill, but based on being a conservative Swiss CFO, I think this will make sure that any acquisitions that we make will be successful. We have learned our lesson from what Bilfinger did 10 or 15 years ago, and we should. Focus in the M&A strategy. Of course, we have started a bit more actively to look at this, as we also believe that we now are stable enough to have a clearer look at what would make sense. Bolt-on M&A priorities would be core geographics, where we see that a combination of an acquisition and organic growth would bring us much faster ahead. But also core industry, where we, as a potential new owner, see clearly strong synergies that would justify that we would make an acquisition. And I also would have a close look at the margin. It doesn't mean that these companies have to be at 12%, but we need to know exactly how we, within 12, 15 months, can bring these targets to a 12% or even beyond 12% operating margin. Sources of funds, beyond our own ability to improve our cash generation, is of course the fact that we have the 49% investment in Apleona, where the market and rumors are saying that EQT will try to sell that. And we know that we have a balance sheet position of 240 million. By the way, the same amount as we have showed previously, so we did not adjust in the last 2 quarters anything. 240 million, which we regard to be a conservative number if EQT would trigger a sale and Apleona would be sold. So these are the funds, our own ability, spending less on working capital, improving the profitability, spending less on adjustments, and then to some extent, if the money for Napoleona is coming in, these will be sources of funds that could be used for a justifiable M&A. Of course, could be used, but I also try to convince that we're not going to spend the money for the sake of having the money. We will have very, very strong criteria before we are going ahead and making further acquisitions. But we are convinced in the management team that there are acquisitions that really would bring a strong additional value also for Bilfinger and also to the shareholders. With that, I would like to get back to Tom to summarize.